tax season isn't just about scrambling for receipts and dreading that final number. This year, what if tax season became the moment you quietly set yourself up for a tax-free, seven-figure retirement using just a handful of powerful ETFs inside your Roth IRA? Think about it. While most people are stressing about what they owe, you could be locking in contributions that your future self will withdraw completely tax-free. No capital gains tax, no tax on dividends, no tax on growth. If your money is going to work hard, your Roth IRA is where you want your highest performers, your best, most aggressive growth ETFs, doing the heavy lifting. Here's the mindset shift. Your Roth IRA is not a savings account. It's your personal government-approved tax shelter for long-term, high-growth investments. You already paid tax on the income going in. That means the IRS doesn't get a second bite when that money doubles, triples, or 10 times as. So instead of filling it with safe bonds or cash-like funds, this is where you want to place the long-term rockets. Broad market growth ETFs and focused growth funds that benefit from decades of compounding. Now, before diving into specific ETFs, one core principle. Your Roth IRA is a long-term game. Think 20, 30, even 40 years. That long runway is exactly why growth-focused ETFs make sense here. Yes, they're volatile. Yes, they can drop 20 to 30% in bad years. But over decades, that volatility becomes noise, and the trend is what matters. And if that trend plays out inside a tax-free container, that's where serious wealth is built. Let's put numbers on it. Imagine you invest $7,000 into a Roth IRA this year and choose a growth ETF averaging 10 to 12% annually over the long run. At 10%, that one contribution becomes about $49,000 in 30 years. At 12%, it's closer to $70,000. Now imagine doing that every year, stacking contributions with smart ETF choices. You're not just investing, you're building a tax-free money machine. So what kind of ETFs deserve a spot on that tax-free pedestal? Start with a broad U.S. total market or large cap growth ETF as your core. These funds spread your risk across hundreds of companies, giants like Apple, Microsoft, and Amazon, plus emerging winners you may never have heard of. Instead of betting on one stock to be the next big thing, you ride the entire wave of American innovation. A total market or large cap growth ETF is like owning a slice of the entire U.S. economic engine, and in a Roth, all that growth belongs to you and you alone. Layered on top of that, you want a dedicated growth ETF, something focused on companies with high earnings growth, strong reinvestment, and long runways. These ETFs tend to tilt heavily toward tech, consumer innovation, and healthcare disruptors. They might be more volatile than a total market fund, but over a long horizon, they can push your average returns higher. The Roth structure absorbs that volatility beautifully because you're not trying to trade in and out. You're buying and holding. Then comes the tech-heavy or NASDAQ-style ETF. This is your turbocharger. These funds concentrate heavily in technology, communication services, and growth leaders. AI, cloud computing, semiconductors, software, they can be the most aggressive part of your Roth portfolio. The downside? Big swings. The upside? Some of the strongest long-term returns in the market. Held in a taxable account, actively trading these could generate painful capital gains taxes. Held in a Roth for 15 to 20 years, it's raw, untaxed growth. To balance that, consider adding a small cap or small cap value ETF. Small caps are the scrappy up-and-comers, businesses earlier on their growth curve. Historically, small cap stocks have often outperformed large caps over long periods, but with more volatility. Putting a slice, say 10 to 20% of your Roth IRA into a small cap or small cap value ETF can add extra fuel. The dividends and gains from these more volatile names are exactly the kind of thing you want shielded from tax. You can then sprinkle in international exposure using a broad international or total ex-US ETF. This brings in Europe, Japan, emerging markets, and other regions. Why bother if U.S. growth is so strong? Diversification. Sometimes international markets outperform U.S. markets over multi-year stretches. Having 10 to 20% of your Roth in a low-cost international ETF spreads your bets beyond one country. And again, foreign dividends and currency-driven gains are simpler to deal with inside a tax-free wrapper. Now let's talk about what makes ETFs themselves tax efficient and why that matters, even inside a Roth. ETFs use a creation/redemption mechanism that lets them shuffle underlying holdings without triggering as many capital gains as traditional mutual funds. In a taxable account, that means lower annual tax bills. In a Roth, it means your fund isn't constantly realizing gains behind the scenes. It's quietly compounding. You're stacking an already tax-efficient vehicle inside a tax-free container. It's like double insulation. But there's another angle. Growth ETFs usually pay relatively low dividends compared to high yield or bond funds. In a taxable account, dividends are taxable every year. In a Roth, you don't care. But by combining low dividend payouts with high reinvestment, growth ETFs essentially reinvest earnings inside the companies, boosting share prices instead of constantly distributing cash. That price appreciation is the kind of thing you want locked inside a Roth forever. So how do you actually put this together inside a Roth IRA in 2025? Imagine a simple yet powerful allocation for a long-term investor. 40% in a US total market or large cap growth ETF minus 25% in a pure growth ETF tilted toward fast growers. Minus 15% in a tech heavy or NASDAQ style ETF. Minus 10% in a small cap or small cap value ETF. Minus 10% in an international ETF. This mix gives you broad coverage, strong growth tilt, global reach, and exposure to both giants and small challengers. You get diversification without watering down your growth potential. If you're more conservative, you can increase the total market portion and reduce the pure tech and small cap slices. If you're younger and more aggressive, you can tilt more heavily toward growth and tech. But here's the key. That allocation is not some rigid rule carved in stone. It's a starting framework you can bend around your real life. If you're in your early or mid-20s, you might lean even harder into growth and tech because your biggest asset isn't money, it's time. You can afford to ride out gut-wrenching drops because you've got 30 or 40 years of compounding ahead of you. In that case, maybe your mix looks more like 30% total market, 35% growth, 20% tech, 10% small cap, and 5% international. More aggressive, more volatile, but with more upside baked in. On the other hand, if you're in your late 40s or early 50s, with retirement starting to peak over the horizon, you might dial things back a notch. You still want growth, this is a Roth after all, but you probably don't want your entire portfolio swinging 30% in a single year. For you, a calmer version might be 50% total market, 20% growth, 10% tech, 10% small cap, 10% international. Same building blocks, just shifted slightly towards stability while still taking advantage of tax-free growth. Another angle most people ignore. Your Roth IRA does not exist in a vacuum. You have 401s, Ks, maybe a taxable brokerage account, maybe even an HSA. You can think of all of these buckets together as your master portfolio, then decide which assets belong where. For example, if your 401k is stuffed with a target date fund that's already heavy on bonds, you might choose to make your Roth the pure growth engine that tilts harder into equities. That way, across all accounts, you're balanced. But the Roth is still doing the heavy lifting on the growth side. This is also where tax location strategy quietly makes you look like a genius in 20 years. The general rule of thumb: put your most tax-inefficient, highest upside stuff in the accounts with the best tax treatment. High-yield bonds or REITs, which spit off a lot of taxable income, fit well in tax-advantaged accounts. Fast-growing, high-turnover strategies, also better sheltered. Low-turnover, hyper-tax-efficient funds like broad index ETFs can sit safely in taxable accounts if needed, so when you're choosing what goes into your Roth, ask, which of my investments will hurt the most in a taxable account? Those are your Roth candidates. One more thing that almost no one talks about: behavior. Picking ETFs is the easy part. Sticking with them when the market is down 25% and headlines are screaming, "This time is different," is the real test. Your Roth IRA should be built in a way that you can emotionally handle. If you know that seeing a 40% drawdown will make you sell at the bottom, Building a hyper-aggressive portfolio you can't stomach is actually worse than choosing something slightly less optimal on paper. Sometimes the best Roth IRA portfolio is the one you can sleep with at night and stick with for decades. So as you look at those percentages, 40% here, 25% there, don't just think in terms of numbers. Think in terms of your own psychology, your age, your income stability, and your other accounts. The goal isn't to build the mathematically perfect portfolio. The goal is to build a Roth setup that fits your reality, harnesses long-term growth, and lets tax-free compounding quietly do its thing in the background while you live your life. Now, strategy, how and when you contribute matters. One powerful move is to contribute as early in the tax year as possible. Tax law allows you to contribute for a tax year up to the filing deadline. But the earlier your money is invested, the more time it has to compound. Putting $7,000 in January instead of next April gives you 15 extra months of potential market exposure. Over decades, those early contributions can make a surprising difference. If dropping a lump sum feels scary, automatic monthly contributions are your friend. Set up $500 or $600 a month going straight into your Roth and into your chosen ETFs. That's dollar cost averaging. You're buying shares in up and down markets, smoothing out your entry price. Instead of trying to time the market and probably getting it wrong, you let time in the market work for you. Rebalancing is another key Roth strategy. Over time, your tech or growth funds might outpace everything else and swell to a bigger portion of your portfolio. Once a year, take a look at your percentages. If your plan was 40, 25, 15, 10, 10, but now tech has ballooned to 25%, you can sell a bit of that ETF and buy more of your lagging areas. In a taxable account, that might trigger gains and a tax bill. Inside a Roth, you can rebalance freely. No tax consequences, no penalty, just realigning to your long-term plan. Contribution limits also matter. For 2025, you're capped at the annual Roth limit, plus catch-up if you're over 50. The key is, don't leave that space empty. Every year you don't use your Roth room is a year of tax-free growth you can never get back. Think of your Roth contribution like an expiring ticket. Once that year is gone, the unused space disappears. If your income is too high to contribute directly to a Roth, strategies like the backdoor Roth may apply, contributing to a traditional IRA and then converting to a Roth, following the rules carefully. That's something to research or discuss with a professional, but the end game is the same. Get money into that Roth shell, then fill it with the best long-term growth ETFs you can find. Another subtle but powerful point, your Roth is a great place to hold the least tax-friendly assets. For example, growth ETFs that might produce occasional large gains, or strategies that tilt towards smaller, more volatile names. Assets you want to trade or rebalance more frequently belong in Roth first, taxable last. Meanwhile, ultra-tax-efficient broad index funds can sit in a taxable account without causing too much yearly tax drag. Now imagine yourself at 55 or 60 looking back. You've contributed regularly through bull markets and bear markets. You ignored panic headlines, kept buying the same low-cost growth ETFs, and rebalanced annually. Your Roth IRA isn't just a line item. It's the engine that's going to fund your travel, your hobbies, and your freedom without the fear of surprise tax bombs. Maybe you started with $3,000 in your first year and gradually worked up to the max. Maybe you began late but cranked up contributions aggressively. Either way, the combination of a Roth structure plus growth-focused ETFs works quietly in the background. You're free to choose when and how you withdraw, without worrying about pushing yourself into a higher tax bracket in retirement. And that's the real magic here, flexibility. Traditional retirement accounts are fantastic for tax deferral, but every withdrawal in retirement gets taxed as ordinary income. With a Roth, qualified withdrawals don't touch your tax bracket. That gives you the flexibility to control how much taxable income you recognize from other sources, Social Security, pensions, rentals, part-time work, while using your Roth as a tax-free buffer. So when you think tax season, don't just think refund or bill, think reset. This is the moment each year where you get to decide, am I going to let my Roth sit underused, or am I going to load it with the best long-term growth assets I can find? Am I going to treat this like a side thought or like the core of my future financial freedom? Here's the simple blueprint you can follow starting this tax season. Decide your target allocation between total market, growth, tech, small cap, and international. Open or fund your Roth IRA at a low-cost broker. Set automatic monthly contributions so you don't rely on willpower. Buy your chosen ETFs consistently according to your plan. Review once a year, rebalance, and resist the urge to tinker every week. Tax season is when most people look backward at what they earned, what they spent, what they owe. Use it to look forward. Use it to build something that your future self will thank you for when the numbers on the screen don't just represent investments, but freedom. Because when you combine a Roth IRA with the right growth-focused ETFs, you're not just trying to save for retirement. You're quietly building a tax-free empire in the background of your life, one contribution, one ETF, and one tax season at a time. Take 30 seconds now, save this, review your portfolio, and level up your tax-free future. Tap like, drop a comment, and share this video with a friend who still hasn't fixed their Roth IRA. Hit subscribe and turn on the bell so you never miss the best 2025 ETF ideas.